Well, greetings, SALT students. SALT students? Yes, state and local tax students. This is a supplement to one of the classes that we had where we did not get to the net operating loss carry forward, carry back concept within the discussion of corporate income taxes within the states. As a background, you may recall that the formula for taxation within the states often, not always, but often starts with the federal taxable income. Start there, whatever that number is from the federal tax return, and then you do some pluses, you do some minuses depending on the state's tax law. We talked about why there could be pluses and minuses, and after you do the math, you wind up with the state taxable income, and then you apply the apportionment factor to that number, the state taxable income. You apply the apportionment if it's doing business in more than one state, and the apportionment factor we learned can be a three-factor or a one-factor. It could be payroll, property, and sales for the three-factor. It could be just sales as a one-factor apportionment concept. But the general formula starts like this and goes down. Some states don't start with federal taxable income and have their own laws, but we talked about why many states do it this way. All right, having said that, let's go back to the issue at hand, which is to illustrate how the formula in the state can make two states that are doing the same thing, basically, but vary, how their approach to the formula, particularly and specifically when there's apportionment. That's what we're going to talk about. And we're going to talk about it with the net operating loss, what we call the NOL. For some further background, let me restate that what we're going to be illustrating is that depending on how the state applies the adjustment inside of the federal taxable income, or starting with the federal taxable income, how the state says to apply it when they have an apportionment factor can make a big difference on the net taxable income when there is a net operating loss. In fact, it could even go further than that. Some states don't even allow a net operating loss at all from the federal, so it'll be a complete add back if there was a net operating loss. And let's get some background even further on what is a net operating loss. Because for those of you who may have not taken business taxation, I think it's appropriate to get that. First of all, business could have in year one, business entity could have profit, 300K, and then in year two, they could have a loss of $200,000. Everything's going to work out according to what you would expect. They're going to pay tax in year one on 300, and then in year two, they're going to have this loss. So what the federal tax law says is this loss in year two can be carried back, 2 years, but we're just going to do a simple example. It can be carried back to a year where there was profit. That's what the federal tax law allows. And the reason, of course, is because it makes sense. Why are we having this arbitrary cutoff of December 31 at the end of a year and say, oh, so this is taxable here, and this is a loss, but that doesn't. You don't have to pay any tax here. There's no tax this year, but you did have to pay tax over here in year one. When the arbitrary cutoff date of that calendar year, between the 2 years, really, what did you make? Between the 2 years, you really only made 100K. So the federal tax law says, all right, so we'll give you the benefit of the doubt, we'll allow you to carry back a loss 2 years backwards, and then if you don't use it up, you can carry it 3 years forward, so that it gets rid of this arbitrary demarcation, and we wind up fairly taxing you on what your net income was over a extended period of time. It's a way of making the playing field fair by not just saying, well, you made it. If you made it here, you pay tax, and too bad about the fact that you lost later on. That's the general concept of the NOL, carry back and carry forward. This is the net operating loss. and you get to carry it back. That's one choice. The other choice is you can carry it forward to future profitable years and wipe out or not wipe out, but reduce future profit or wipe it out, depending on how much the future profit is. It's all a matter of numbers, of course. All right, so that's the basic concept of a net operating loss and the carry back, carry forward of that net operating loss. So in the formula with the state, starts off with the federal taxable income. The federal taxable income already has the net operating loss calculated. So in the example we had before, let's say we did it this way. Let's say in year one, this is year one, we had a $300,000. Well, let's do it a little differently. Let's say in year one we had a $200,000 loss, and in year two we had $300,000 of income. Using the carry forward on the federal return, we would wind up having federal taxable income of 100. So on the state return, you'd first start off with the 100,000, and then you'd have to do the pluses and minuses and come to the state taxable amount. And now the question is, how is the state going to look at this particular part of the federal return, the net operating loss? How is it going to apply that? And the example could be in a number of ways. And let's see exactly which example we have. The net operating loss for federal purposes, this just tells you it can be carried back 2 years. I might have misstated and gave you the capital gain carry forward. Here it's 20 years. This is the federal rule. And notice what we write here. Few states conform to this, which means we've got plenty of fun when it comes to the application of this one particular adjustment to the state income taxes. Remember, there are many adjustments that states have to the federal taxable income. This is just one that I'm picking out to go through in detail for illustration purposes. And so most tend to limit the availability of the NOL. Some states like Pennsylvania don't even allow it. And let's take a look at a very simple example of how that works. Here's just, again, some more pointers before we look at the example. Maybe the state doesn't allow the carryover for 20 years or back 2 years. Doesn't allow any carryback or forward. Maybe there's a dollar limitation. This is where we're going to concentrate our example. And this is sort of a esoteric, just to let you know that there are many variations that can happen. So this is the one we want to see how, as an illustration, how state law can make a big difference one state to the next based on how they write the tax law. Here's the example we're going to use. It's actually pretty simple, so don't let this throw you into a frenzy of panic. It's actually pretty easy to follow. Here's what we're going to do. This is the example we're going to have is in year one, the entity had a $200,000 loss. So for the federal return in year one, they had a $200,000 loss, which pretending that it didn't get carried back, you could make the example being this is its first year in business, and it had a loss the first year. So it goes into the next year, and next year it makes income. Yay, yay, yay. Right there. And what the federal law allows you to do is to net these two in year two. So in year one, you would have shown a loss of $200K. This would have been year one. And you would have said on your federal return, I now have a net operating loss carry forward of that amount that goes to year two. So in year two, when you had $300,000 of income, you'll pull this over and say, well, this is my carry forward of a loss, and you will only pay tax on the net of 100. And that's why we see, as in example one, that the federal income tax return starts off, or the state income tax return over here, starts off with the federal taxable income of the 100K as it would have appeared on the federal return. So this is how it would have appeared on the federal return. This particular state follows it that way and starts off with the $100,000 federal return, and then it applies the apportionment factor. And this is just one state, and let's clear the deck a little bit to be able to see it better. So I'm going to erase the ink, and we're going to say that in state 1 here, they start with the federal. The law says we start with the federal, and we apply the apportionment factor. This example will actually teach you a little bit more about the apportionment factors and how they work in a way that may have not been as apparent in class, which is, let's go back up to here and notice that in year 1, the apportionment factor for this particular state was 30%, 30% to that state. 70% went to whatever other states the business was dealing in. The next year, interestingly enough, the apportionment factor was 45%. So 45% got taxed in the state, and 55% went to the other states. The income was allocated 55% to the other states and 45% to the state we're talking about. Why does it change from year to year? Well, the factors change. If you're using just one factor, as an example, the sales factor, one year 30% of the sales was in this state, and the next year was more. So it changes. Every year that apportionment factor can change based on the facts and circumstances. Okay, let's stop here for a minute, and then we'll pick it up on the next tape or next video. So we'll hold here, and we'll come right back to this.